If you've never invested before, if you're feeling stuck or looking for fresh ideas or inspiration, here's your quick investing plan to kick off 2026. Now, the first thing you need to do before you start investing or trading is to open up an investing or trading account if you already don't have one. So, platforms like ours at Moomoo allow you to buy US, Australian, and Hong Kong shares and exchange traded funds or ETFs all in one place. The process is really easy, and platforms like ours, such as Moomoo, they're pretty rich in content, investing inspiration, share market information, and we've got plenty of resources to help you along the way. The second thing that you need to do can be as simple or complex as you want it to be. It's basically where you figure out the right investments for you. Basically, what do you buy? So you can buy individual companies, we call them stocks. So think about Google, Microsoft, Nvidia. We know these three stocks have risen by 350, 300, or 400% respectively over the past 5 years. That's pretty red hot, right? But you can also invest in entire stock markets like the US stock market, the Aussie share market, and Hong Kong's market as well. And these three markets have got long, strong histories of rising over the long term. So if we think about the US, that's risen on average 10% per year throughout history. The Aussie share market, it's not done as strong as that. But if you include dividends, which Australian companies are rich in paying out dividends, that's what we found throughout history. The average return is also about 9 to 10% per year. Again, only if you include dividends. Hong Kong's market has also produced similar returns, moving towards the high single digit annual return cycle over the long term. Now, each market has also got a strong history of generating returns over the long term. And these three regions also have strong histories of recovering from market crashes. That's what we've seen throughout history. Of course, history never repeats itself, but it does rhyme. Something to also consider is to honour the words of the late Charlie Munger. He famously said, "Big money is not in buying and selling, but it's in the waiting." So think about investing for the long term. That's one way to consider building wealth. You can invest in an entire stock market, as we're saying, or you can also invest in themes or sectors through exchange traded funds. So you can buy or sell ETFs just like you buy or sell a company's shares. But the great way about using ETFs is it gives you broad exposure to the things that you like. Today, we're going to keep it pretty simple, but I'm going to share my view and what I think are the hottest investments that you need to consider. So stick around to the end. We'll be covering those. But just one quick point. If you're not quite ready to start investing or trading, you could consider paper trading. This is basically where you use virtual money on the Moomoo platform, and it's a great risk-free way to get to know how to trade the stocks you like. And it's a great way for you to experience share market investing. And you can test all your ideas too. So I really do like paper trading. Check it out. The third step is to not just invest, but to invest often. So this comes back to the point we just made that waiting and building your investments over time is where a lot of value and money is made. Now, many successful investors are also set up recurring investments. This is something that I do, and you can do it too on the Moomoo app under the Accounts tab. And this is where you can set up monthly or quarterly recurring investments. And this is a great way where you can actually maximize your returns over time using the power of compounding interest. So the other thing is to consider is when we are investing often and frequent, we're also reducing market timing risk. This is basically what we call dollar cost averaging. Again, going back to that principle of investing regularly, you're basically being not focused on the market's ups and the downs, but you're investing regardless of what happens. With this in mind, I want us to think about the legendary investor. Some of you might know Peter Lynch. He famously said, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. So that's something for you to consider. What we're basically trying to say is even small regular investments into growth assets can build significant wealth over time. Step 4 to investing is to be intentional and review your investments. Just as you wouldn't enter a relationship or get married without understanding your partner, you should not invest in a company without understanding what you're investing into. So you also need to review your investments periodically, maybe once or twice a year, and reassess how it's going. Have the goals of the companies changed, or have your goals personally changed? Also, remember that great investors don't necessarily react to market day to day headlines. We've seen Trump cause lots of market headlines, but many wise investors use market pullbacks, basically share price falls, to buy into those quality investments that they like because they're taking advantage of buying them at a cheaper price. And that's how a lot of successful investors build great generational wealth. The fourth thing that we want you to consider, as promised, is we're going to run through the key investing areas that I like in 2026. So stay with me and think about whether these investments are right for you and whether perhaps you should consider buying them. The first one is the US stock market. So, why would you invest in the US stock market? Well, it's the most valued market in the world, home to the largest companies in the world that have the strongest earnings growth over time. Warren Buffett also says that if you're not willing to do your own research on individual companies, you should simply buy the S&P 500. That's, as the name suggests, the index of the 500 largest US companies. Over the long term, ETFs that track the S&P 500 have also delivered about 10% per year. That's despite recessions, despite wars, despite headlines, inflation and market crashes, everything, you name it. Now, two ETFs that you could consider investing in the S&P 500 are the Spider S&P 500 ETF that goes by the ticker of SPY, or the Vanguard S&P 500 ETF. I personally prefer the NASDAQ 100. This has delivered returns of greater than the S&P 500. It delivers returns of 14 to 15% per year on average over the long term. And this is because the NASDAQ 100, the biggest tech stocks in the US, deliver greater earnings growth than the biggest 500 companies in the US. So if you want to invest in the NASDAQ 100, you can do this via ETFs like the Invesco QQQ or BetaShares NASDAQ 100 ETF. The second theme that I think is going to generate some of the strongest investment returns is artificial intelligence. AI is expected to deliver some of the strongest earnings growth this decade and indeed right through to 2030, delivering some of the strongest investment returns. So this is driven by data centers, cloud computing, semiconductors, software, and AI ETFs to consider. Maybe for you, you could add some of these to your portfolio, are the Global X Artificial Intelligence and Technology ETFs, or the Robo Global Artificial Intelligence ETF, or there's also the iShares Robotics and AI ETF as well. So you can see here the latest deep dive video in this sector. Take a look at this sector, get to know it more. We're going to link that in the description below. The third area that I really like is commodities. Now, the surge of AI, data centers, the electrification, of course, the rising of defense spending, all of this means we are seeing greater demand for key commodities to build out these core, the core ecosystems that support it all. So a lot of this is single-handedly causing a greater than expected demand push in silver, platinum, copper, lithium, and gold. And this is why the commodity prices have seen strong double-digit gains over the past year. This is why we are seeing demand is rising stronger than supply. ETFs to consider in commodities include the Spider Gold Shares ETF, the Global X Copper Miners ETF, and the Global X Lithium and Battery Tech ETF. Again, here's my latest take on this sector. To explain more about what's going on, you can find that in the description below. The fourth area to consider investing in is defense. Now, defense spending is in a structural long-term trend tailwind. Now, we do know countries are being encouraged by NATO to spend at least 2% of the amount of money that they make as a nation on defense and cybersecurity. Many governments we know are already increasing their budgets far beyond that level. This includes areas like the US and the EU. Now, defense ETFs, they've performed really strongly over the past 5 years, and this trend is probably going to continue, particularly because we do have US, EU, and Australia increasing defense spending. So if you do want to invest in ETFs in this area, you could consider the iShares US Aerospace and Defense ETF, as well as the maybe Global X Defense Tech ETF. There's also the Spider S&P 500 Aerospace ETF, and you can invest in the European equivalents of these as well. So to summarize, where to go from here, open an account. Once you're ready, invest in what you want and invest as often as you can. And don't forget to schedule a time to review all your investments. As Warren Buffett says, the best time to invest was yesterday. The next best time is today. Now, we keep you up to date each morning with stocks and sectors and trends in the market. So subscribe to the Daily Moo through your podcast platform or choice. And we look forward to seeing your comments. Take care, stay safe, happy trading.